All right, guys, let's start. Okay, so now we are doing your new chapter, which is a new topic, basically yield curve modeling. And yield curve modeling, we have chapter number one, which is introduction to yield curve, and in that, the lesson number one is about term structure of interest rate, discount factor, right? So, basic idea is that the lesson covers the term structure, which means how the interest rate change with time or terms, right? We look at term structure of interest rate, we look at a discount factor, we look at bootstrapping, we look at curve interpolation, we look at fitted models which will come later, right? So that's the whole idea. Okay. So let's start, guys. Let's dig deeper, understand more. So let's try to understand this. When we talk about the term structure of uh, interest rate, let's talk about the definition and financial importance. So what's given the slide, basically term structure of interest rate describes how interest rate vary across different maturities of financial instruments. Formally, it represents the functional relationship which is given by this equation. R is equal to function of time, where R denotes the interest rate, T denotes the time to maturity. In practical terms, it indicates the cost of borrowing or lending money today at different horizons, 1 month, 6 months, 1 year, 10 year, and beyond. Term structure plays a central role in your bond pricing and yield curve construction, derivative valuation swaps, FRAs option, risk management, duration analysis, monetary policy transmission analysis, core component of the term structure, spot rates, zero coupon yield, forward rates, implied future rates, discount factor, present value multipliers, right? So if you look at the definition, right? The definition is one formula, a list of four uses, and a list of three components, which is given. Formula is given R is equal to FT, R is equal to function of capital T, right? So uh, R is the interest rate quoted as an annual percentage. T is the time to maturity measured in years. F is a function that assigns one rate to each maturity. The formula says the rate you get depends on how long you lend. Each maturity has its own rate. The full set of maturity rate pairs is the new structure or the term structure. New terms are spot rate, which is zero coupon yield. The single rate earned on money lent today and repaid once on money uh, in full at maturity T, right? No intermediate payments. Forward rate is the rate agreed today for lending over a future period, such as year one to year two. Discount factor is the present value today of 1 unit of currency paid at T. One clarification I'll add here is when we say R is a function of T, is a snapshot taken on one date, written properly as R T comma T, right? Where T is today's date and capital T is the maturity date. A term structure also belongs to one currency and one credit or collateral type. Government bond rates and bank funding rates are two different curves which we need to understand. Mixing the credit spread. Where it is used, the slide lists bond pricing, derivative valuation, duration, and risk work and policy analysis. Every one of these starts by reading rate of this curve, right? Then we get into the next part, which is understanding discount factor, present value representation. And what is the discount factor? Basically, discount factor represents the present value of receiving 1 unit of currency at a future time T, given by this formula where df of T is equal to 1 by R plus R T. This party R T is the spot rate of maturity T and T is the time to maturity. Discount factor translates future cash flow into face value, present value given CF sub T into DF T. Thus, the yield curve can be equivalently expressed as curve or discount factor instead of interest rate, right? So, again, when you look at the formula which is given, DF of capital T equals 1 divided by open bracket 1 R sub capital T close bracket always to power capital T, right? So, DF of capital T, today's value of 1 unit of currency paid at time T. R sub T is the annually compound spot rate on maturity T. The subscript T, capital T on R means the rate is the one for that maturity, not a single rate for all maturity. The formula divides 1 unit of future money by the growth factor over T years. Money left in the bank at R sub capital T multiplied by 1 plus R sub capital T raised by T, dividing reverse that growth. Formula 2, which is given present value equal to CF sub capital T into DF T. Present value equals CF sub capital T multiplied by DF of capital T, right? CF sub capital T is the cash flow received at time T. The formula scales any future amount down. Today, the discount factor does the work. That is why the curve of the discount factor carries the same content as the curve of rate. I'll add one clarification that DF of t, discount factor of t is less than or equal to 1 only when RT greater than or equal to 0 under negative rate. The discount factor exceeds 1. So also t in the exponent must be made on the same day count basis used to quote R sub t. The rate quoted on actual by 360 and a t measure on 30 by 360 will not agree. Where it is used, trading systems store the curve where discount factor is not rate, every present value in fixed income book is the cash flow multiplied by discount factor. Uh, then we go to next part, slide number 4, which is discount factors, numerical illustration, example with annual compounding. Suppose the 1 year spot rate is 5% with annual compounding. The calculation is given. Interpretation: receiving $1 in 1 year with worth 0.952 for today. In other words, $1 future value equals 25.2% in present value. Discount factors form the foundation of bond pricing, swap valuation, forward rate construction, entire yield curve modeling. The complete term structure can therefore be viewed as a sequence of discount factor, which is given by this equation, right? So again, there's nothing here, right? It's a very simple kind of illustration. The last point I'll highlight, right, which is uh, discount factor of t when t greater than 0 means the collection of discount factor for every maturity greater than 0. This is the discount curve. Okay, that we need to understand, right? Then we go to relationship between discount factors and spot rate, annual compounding for a zero coupon bond with maturity t that are subcapital T, the annualized spot rate and the normal compounding. Discount factor representation, this formula we have already seen, inverse relationship spot rate from DF. It just, reworking on the formula, economic interpretation, spot rate and discount factors contain identical information. A higher R sub capital T implies a lower DF. Discount factor of T, the zero coupon bond price equals DFT, thus the yield curve can equivalently be expressed as a spot rate curve or a discount factor curve. Okay. So if you look at the relationship, right, relationship between discount factor and spot rates, what's given on the slide is same formula which you have seen earlier. Again, these two formulas are just given because second formula runs the first formula backwards. Total growth over t years, taking over t through turns, total growth into growth per year, subtracting one strip of the principal leaves the rate. Only clarification I'll add here is that the slide says the zero coupon bond price equals discount factor t. That holds only for a face value of 1 unit for a bond with face value, let's say 100. The price is 100 into the year. And discount factor t, right? Discount factors are always quoted per unit of face. Please remember that. Where it is used, curve builders quote discount factors and convert to zero rates for reporting. Two direction must round trip exactly as the curve has an inconsistency, right? Then we have next one, discount factor under continuous compounding. Continuous compounding, let R subcapital T denote the continuous compounded spot rate liquidity. Discount factor representation DF T is equal to exponential minus R sub T into T. Inverse relationship spot rate from DF R sub T, R sub capital T is equal to 1 minus T ln log of ln DFT. Why continuous compounding is preferred in quant finance? Because algebraic simplicity, stochastic calculus, linear relationship in exponent, simplified differentiation, natural formulation, no arbitrage, term structure model. Continuous compounding is standard in HGM framework, Jerome Merton framework, LMM model, LIBOR market model, affine term structure model, etc. Right? So again, what's given on the slide is a continuous compounding version of both formulas, 3 reasons for using them, and 3 model families. When we say the first formula, which is df of capital T equals exponential raised to the power minus r sub capital T times capital T, where exponential is the base of basically natural logarithm roughly equal to like 2.71828. R sub capital T here means the continuous compounded spot rate. It's a different number from the annually compounded rates for the same maturity. Interest is added to the balance at every instant rather than once a year. The growth factor becomes exponential RT into T dividing 1 by it gives exponential minus RT into T. The formula, second formula, which is given R sub capital T equals minus 1 over capital T multiplied by the natural logarithm of df of capital T. Ln is the natural logarithm, the inverse of raising exponential to a power. Taking the log of exponential minus RT into T returns minus RT into T. Dividing by T and flipping the sign leaves RT. The log is negative for a discount factor below 1, so the minus makes the rate positive. So there are two different conventions. One is annual compounding, which is df equal to 1 plus RT raised by T, and one is continuous compounding, where df is equal to exponential minus RT, right? Annual compounding interest added once per year, R recovered by a root, standard for cash, bond, and money market quotes. Continuous compounding interest added at every instant, R recovered by a logarithm, standard for stochastic model. Uh, the one difference that matters here, for the same coded number, continuous compounding grows money faster. So it produces smaller discount factor. A 5% continuous rate equals exponential 0.05 minus 1, 5.127 annually compounded, right? So please understand that. One clarification I'll add here, when you look at the LIBOR market model, the LMM does not use continuous compounding for its rate variables. It models simply compounded forward rates over discrete accrual periods, which is the point of model and the reason it reproduces market gap and swap inputs directly. HGM models the instantaneous forward rate and affine models the instantaneous short rate. Those two are continuous, right? So remember that. Where it is used, Monte Carlo pricing carry rate continuously because the discount factor exponential minus RDS continues or multiplies cleanly across time frame. Then we get into next one, which is graphical representation of discount factor and versus continuous compounding, which is given. Discount factors decline with maturity. Continuous compounding produces slightly lower value. Differences increase for longer maturity. So one chart with two lines and three observations. Horizontal axis maturity T from 0 to 10 years. Vertical axis discount factor T from 0.6 to 0.6 to 1. The blue line uses annual compounding at 5%. Red line uses continuous compounding at 5%. The picture shows discount factor falling maturity with the continuous line sitting slightly below the annual line throughout. 10, the annual curve gives 1.05 raised to power minus 10, right? 1.05 raised to power minus 10, which gives you 0.6139. Your continuous curve gives exponential 0.5, which gives 0.6065. So third observation that the difference increases for longer maturities too only over the range plotted. The gap in absolute term peaks near 25 years and then shrinks back toward 0 because both discount factor converge to 0 at T grows. For 0 to T, here the statement holds. The two lines also use the same number 5% with two different conventions. The gap measures the convention, not any economic difference between the two loads. Okay. Then we have interpretation of the term structure by discount factor. This is the explanation of the previous slide. Economic meaning of discount factor dynamic. Discount factor typically decline as maturity increases, which is given by this data. While discount factor decline, positive time value of money, equity preference, opportunity cost of capital, automatically under positive interest rate. This is what we get, right? So what's on this slide is a kind of a 4-row table, 3 economic reasons and 1 derivative condition. Table column 1 is maturity in years 0.51, 510. Column 2 is the discount factor 0.995, 0.980, 0.875, 0.700. The picture shows the discount factor falling steadily as maturity lengthens. Converting each row to an annually compounded spot rate gave roughly 1.01%, 2.01%, 2.71, and 3.63. This is an upward sloping curve. The formula which is given here, the derivative of df of capital D with respect to capital T is less than 0. dy dt is the derivative with respect to maturity. It measures how fast the discount factor changes the maturity length. So statement says that the discount curve slopes downward everywhere. Each extra day of waiting removes any value. And one clarification I'll add here is the sign follows from positive forward rate, not from positive forward rates in general. And it fails under the negative rate between 2014 and 2022. Euro, JPY, Swiss franc curves had discount factors above 1, rising discount curves at the short end, right? Curve software must allow discount factor greater than 1. 3 distinct reasons also do different jobs. Positive value gives the downward slope, liquidity preference, and opportunity cost of theories about the level and the shape of the rates, not about the sign of the derivatives. Where to use collateral discounting depends on this sign. A rising discount curve changes the actual collateral valuation adjustment, right? So all these future cash flows are worth less today. Positive time value of money. Investor prefer immediate consumption, equity preference, opportunity cost of capital can earn it elsewhere. Right? These are all kind of important things, right? Next, slide number 9, term structure and arbitrage-free pricing, discount factors and bond valuation. Discount factors allow arbitrage-free valuation of any fixed instrument. Consider a coupon bond with cash flows C sub capital T sub T at times equal to 1 to till T and face value F at maturity. Arbitrage-free arbitrage-free bond pricing formula is given here. Each cash flow discounted using corresponding 0 coupon discount factor key inside. The bond is equivalent to a portfolio of zero coupon bond. The term structure provides a unique no arbitrage price. No assumptions about expected returns are required. Thus, the entire fixed income market can be priced consistently with the discount curve removed. Okay. So what's given here? Basically, the general bond pricing formula and three consequences of it. P naught equals the sum from T equals 1 to capital T of C sub T times TF of T plus capital F times GF of capital T. P naught is the bond price today. The subscript 0 means time 0 exponential T T01 to T add up to the terms that follow for T01, T02, and so on up to T0T. C sub T is the coupon paid at time T. F is the face value paid in the maturity. DFT is basically the discount factor of the date, the cash flow, right? Each cash flow is discounted with a factor for its own date. Then the discounted amounts are added different date, usually different rates. The result is the price implied by the curve, right? One clarification I'll add here is that this prices your default free cash flows of a matching curve, right? A corporate bond needs discount factor that already contain the issuer's credit spread or a separate spread added to the rate. The formula assumes the final coupon C subcapital T, right? And the face value F are two separate terms. In practice, they arrive together. So the last cash flow is CT plus F, right? So do not count any of them twice, right? Where to use this is a present value engine on every fixed income book, right? Risk numbers are computed by shifting the discount factor and computing P naught. Then we go to next one, which is arbitrage consistency and yield curve modeling. No arbitrage principle in terms of a model. The market prices violate, then we get this is the formula and arbitrage opportunity exists. Example of arbitrage: suppose a bond trades above its theoretical price, sells overpriced bond, replicate its cash flow using zero coupon bond. Lock in the risk-free rate, therefore the yield curve construction must enforce this thing, modern term structure, model ensure arbitrage free dynamics, HGM, LMM, FE term structure model, right? So again, if you look at the slide is basically giving you a formula which is P naught equals the sum from T equals 1 to capital T of C sub T times DF of T. Same statement which was given in slide number 9 also with the face value added to the final C T. If the traded price differ from the sum, the bond and the strip of zero disagree about the same cash flow. But the trade, again, you sell the overpriced thing, right? Sell the bond at the high market price, buy the open bond and pay exactly the same amount on the same dates at the lower total cost. Every future obligation is kind of covered. The difference is kept today with no residual risk. And if you look at the second formula, which is given below, DF of capital T2 is less than or equal to DF of capital T1. Whenever capital 2 is T2 is greater than capital T1, T1 and T2, two maturity dates with T2 the later one. The condition says the later payment can never be worth more today than earlier on the same side. If the rate curve breaks it, the curve implies a negative forward rate between the two dates. One clarification here is the arbitrage argument needs the zero to be tradable, the same trade and same funding. The strip markets are thin, right? Small pricing gaps survive inside your bid offer and are not trades, right? So the monotonicity condition is exactly equivalent to requiring kind of non-negative forward rate. So it's a modeling choice, not a loss of once negative rates are admitted, right? So where it is used, curve fitting enforces this directly. They have cubic splines. So discount factors can produce negative forward, which is why monotone or your shape preserving interpolation is standard on a rate space. Then we get into next part, which is graphical illustration of arbitrage free bond pricing, bond as portfolio of discounted cash flows. So what is on the slide? Basically one chart and 4 interpretation bullets, no formula. Each coupon is discounted using a term structure. Final payment includes coupon plus face value. Bond price equals sum of all discounted cash flow. Any deviation from this equality creates arbitrage, right? So one chart, 4 interpretation bullets, no formula. Chart is horizontal axis given, right? 0 to 5, vertical axis value 0 to 1. The thin black line is the discount factor curve falling from 1 at time 0 to about 0.7 at year 5. The red dot marks the discounted cash flow. A clarification here is that the chart is in kind of, not complete because only one red dot rendered at year 1. So you can kind of extrapolate it to many years, right? That can be done, right? So that is important to understand, right? So what the bullet means here is that each coupon uses a discount factor for its own date. The last payment is coupon and principal together. Adding the discounted amount gives the price any gap between the sum and the traded price. The arbitrage is described on slide number 10, right? So, which is given before it, right? But yeah, that you need to understand. Then next one is this is a complete one. Real world usage of discount factors, bond pricing. Each coupon is counted using the corresponding discount factor. So here, the formula is given, which is P naught equal the sum from T equals 1 to capital T of C sub T times DF of T plus capital F times DF of capital T, right? Each coupon is multiplied with discount factor. For the date it arrives, the face value multiplied with discount factor. For the maturity date, the total is the price today. Horizontal axis time 0 to 5 years, vertical axis value 0 to 1. The thin line is the discount factor curve, the 5 red dots, which were not present in the previous chart, right? The present values of 5 cash flow. The picture shows 4 small dots near 0.05 for the coupons and 1 tall dot, near 0.82 at DF5, right? The tall dot is nothing but like C5 plus F into your DF5, right? Roughly 1.05 into your 0.78, right? The 4 dots are your 0.05 into df small t. The bond price is sum of the 5 dot heights, not the area and the curve. The line and the dot share one vertical axis with very different thing. The line is the value of 1 unit of currency. The dots are present value of actual cash flow. The coupon dot sit far below the line because the coupon is 5% of the unit, not the unit. Where to use is a picture behind stripping and reconstitution. The dealer cancel the dots separately as zero or buy the dots and rebuild the bond. Then we go to next part, swap pricing, fixed leg value, which is given again, what's in the formula, 2 leg valuation formulas, one chart and one caption, new terms, interest rate swap, an agreement to exchange a stream of fixed payments for a stream of floating payments on the same notional. Notional is the reference amount used to size the payments in not exchange. Fixed leg is the slide paying a rate agreed at the start. Floating leg is the slide paying a rate that resets each period. Par swap is a swap fixed rate makes 2 legs for the same at inception. The swap starts at 0 value. Formula 1, which is given here, is nothing but PV fix equal the sum from T equals 1 to capital T of capital K multiplied by DF of T. K is the fixed payment made each period. Each payment is discounted with the factor for its own payment date. The discounted amounts are added. The result is the value of the fixed side today. Formula 2 is PV float equals 1 minus DF of capital T, the floating payment telescope. Each period's floating payment discounted equal the difference between two neighboring discount factors. Adding them all leaves only the first and the last chart, right? And if you look at the chart, right, which is given. Horizontal axis maturity 0 to 5 years, vertical axis discount factor 0.8 to 1. The single line fails from 1 to about 0.78. The picture shows the discount curve used to value both legs. The technical clarification, present value of fixed omits the notional and the actual fraction. The full version is your present value of fixed. All right, where any the notional tau pi is a day count fraction period I setting the two legs equal gives the par swap rate, right? Par swap rate will come as K star 1 minus DFT. So capital K star equals 1 minus df of capital T all divided by the sum from I equals 1 to n of tau sub I times df of T sub I. The numerator is the floating leg value, the denominator is the annuity, the value of 1 unit of rate paid on every fixed date. Dividing converts the present value into the rate that produces it. Present value of float, right, which is given as 1 minus df. T also carries the hidden condition, it requires the same curve to both forecast the floating rate and discount rate with no spread. That was true before your 2008. It's not true now, right? Because see, single curve pre 2008, one curve forecast and discount, floating leg telescopes to 1 minus TFT, value rate, state of the discount curve, one bootstrap curve per currency, right? But after 2008, it's a multi curve, right? Forecast curve and discount curve differ, telescoping fails. Each forward rate computed, then discounted separately. OIS and SOFR, right? SOFR, discount curve plus one forecast curve per tenor. The one difference that matter under multi-curve is that your present value float 1 minus DFT is wrong and the floating leg must be built payment by payment, right? And where it is used, every swap mark to market on a rate book runs through these two sums. Bucket rate DV01 comes from shifting individual account factors and repricing that we need to understand. Then we go to slide number 14, which is forward rate construction, forward rate derived from discount factor, which is given by this formula, which is f of t1 comma t2 equals open bracket df of t1 divided by df of t uh, 2 minus 1 close bracket all divided by t2 minus t1, right? F t1 comma t2 is a simply compounded forward rate for the period running from t1 to t2. Here is the start date of the forward period, t2 is the end date. The ratio dft1 divided by dft2 is the growth factor of the forward period. Subtracting one leaves the total return earned across that period. Dividing by the length of the period turns that total into an annual rate. Here the chart, right? Horizontal axis, time 0 to 5 years, vertical axis, rate 0 to 0.8, table in units of 10 minus 2. The flat line sits at 0.05. The picture shows the flat forward curve, which is what a flat 5% spot curve produces. Spot rate from today to T, forward is rate from T1 to T2, going in the future. Spot rate directly of one discount factor, locked in by lending today. Flat curve, spot equals forward. Forward rate is uh, built from ratio of two discount factor, locked in by borrowing at T1 and lending at T2. Today, flat curves, forward equal spot. The one difference in matter, the spot rate averages the whole path from today to T. The forward rate is the marginal rate for one slice of that path, that is the forward moves more than spots when the curve steepens, right? T2 minus T1 should be the day count fraction tau for that period and the market convention, not the raw difference in the year. The captain also kind of overstates. Forward rates are not the market forecast of future spot rate. They contain a term premium. And for long maturity, the convexity adjustment is also required, right? For most of the last 3 decades, forwards have priced in more rates, rise in actually arrive, right? So where to use forward rates are the pair of references for FRAs, forward rate agreements, the floating leg of swaps, and the cap rate striking in or strikes in the cap pricing. Okay, then we get into next part, risk management, DV01, duration convexity. Duration depends on discounted cash flow, which is this. Bond price and yield arises directly from the shifts, right? So one duration formula, one chart, and one caption. Duration is equal to capital D equal to sum of T times capital sum of T times your CF sub T times TF of T, all divided by P naught. T is the Macaulay duration measured in year. T is the time cash flow arrived. CF sub T is the cash flow time T. P naught is the bond price, which is sum of the discounted cash flow, right? Each cash flow present value is weighted by how long you wait for, dividing by price earns. Those weight into fraction and adding to what? The result is the average waiting time for the bonds money. If you look at the chart, horizontal axis, yield from 1% to 10%, vertical axis, bond price 0.6 to 1. The single line falls and yield rises. The picture shows price moving in opposite direction to yield. Macaulay duration, when we look at, is the weighted average time to cash flow. Units are here. Duration of Macaulay, right, is given by summation D, TFT, DF, TP naught, right, which is same under any compounding convention. Modified duration, when you take the modified, the Macaulay, which was found, right? Right, equals Macaulay under your quantitative compounding, right? So that is what we need to understand. The one difference that matters is Macaulay duration is time, modified duration is festivity. On the second one, hedges. The slide gives Macaulay duration the heading that name DV01 convexity, and that is what we need to keep in mind. DV01 is the price change for a 1 basis point move, right? So DV01 is equal to D modified into P naught into 0.0001. Right, the chart is also drawn a straight line. The two bond price relationship bend upward. The bend is convexity. Keep that in mind, which is the second thing which you need to keep in mind. Straight line has zero convexity, so the picture removes that effect, right? Okay. DV01 is a unit every rate desk hedges in duration alone, underestimate the loss on a large yield move when the gap is what convexity corrects. Then we get into next part, which is HJM and LMM models, discount bond price dynamics, and the HJM, which is given by this equation model, describes evolution discount bonds directly. Like the graph is given in entire structural models around DF evolution, right? So we have one formula here, one line of text, one chart, and one caption. Capital T of T comma capital T equals exponential raised to the power minus the integral from T to capital T of f of T comma u with respect to u. Uh, the PTT, right, that is nothing but the price at time t of a zero coupon bond paying 1 unit at time t. FTU is nothing but the instantaneous forward rate seen at time t applying to a single instant u. The integral is which adds up the quantity contributed across all instant between instances u between t, small t, and capital T. The exponent add every instantaneous forward rate between non-maturity. The total is the cumulative discounting. This is a continuous version of your DF exponential minus RT T, right, with a single flat rate replaced by rate that varies instant by instant. Chart, when we look at horizontal axis, maturity 0 to 10 years, vertical axis bond price 0.6 to 1, the line coils from 1 to about 0.67, the picture shows bond price again with maturity. HGM is a framework, not one model, keep that in mind. Its content is a drift condition once the volatility of forward rate is chosen. No arbitrage sources the drift. The formula shown is only the definition of a bond price for forward rates and holds in every model, right? The slide uh, if you look at it also talks about HGM as well as LMM, right? So LMM model basically discrete forward rates over a cool period, not instantaneous ones. The chart is drawn as straight lines under a constant forward rate. The true shape is exponential decay, which bends upward a little bit, right? And where it is used, Monte Carlo, pricing of Bermuda swap and particle structure, simulation, FTU, forward in time, and rebuild PDT at each step. Then we go to slide number 17, which is example of computing discount factors and spot rate, numerical illustration, and compounding. Suppose zero coupon yields are given, maturity, zero rate, 1 year, 2 year, 4%, 4.5%. Discount factor for 1 year is calculated, discount factor for 2 years. Recovery spot from discount factor is given. Conclusion, discount factor spot rates contain identical information. The term structure representation is internally self-consistent, right? So column one is maturity 1 year and 2 year. Column two is 0 rate, 4%, 4.5%. The picture shows a rising curve across 2 points. The formula is given 1 year is at 4%. The growth factor is 1.04 dividing 1 by reverse. It reverses 1 year of growth. Then 2 year at 4.5% is again calculated, taking the square root of the total 2 year growth gives growth per year, subtracting only its annual rate. The round trip exactly only at full precision using the rounded 0.9157 returns 4.5018%. So that is approximately same, right? This is one step of bootstrapping, taking a quoted rate, producing discount factor, then use the discount factor to solve for the next one. Then we get into next part, visual interpretation, term structure of the curve, zero coupon yield curve. The term structure can be represented by zero coupon yield curve, which is given by this. Definition, horizontal axis maturity, vertical axis zero coupon spot rate, RT. Curve shows how borrowing costs vary across different maturity. Interpretation, upward sloping, higher long-term rates, normal curve, downward sloping. Inverted expectation, hum transitional economic phases mathematically represents the function R equal to FT. The yield curve is the most common market representation of the term structure, right? So the definition of the euro coupon yield curve, its axis, three shapes of the functions again, plot description, R of capital T, plotted against capital T, horizontal axis maturity T. Vertical axis, the zero coupon spotted, and then for that maturity. R equals F of capital T, same statement as slide number 2, 1 rate per maturity, three shapes. Upper sloping means long rate sits above short rate, downward sloping called inverted means the reverse sum means rate, size, and fall across maturity. Zero curve, rate on a single payment at T, par curve, coupon rate that price of bond at 100. Zero curve, no intermediate cash flow, par curve, coupon paid throughout. Zero curve used to build discount factor, par curve quoted directly by market maker. Zero curve derived by bootstrapping, par curve, the raw input to bootstrapping. The one difference that matters, we use zero curve discount, the par curve is quoted, they differ, but whenever the curve is not flat, the gap kind of widens the slope. So the slide calls the yield curve the most common market representation. There's two of the par curve, not the zero curve. The US Treasury, CMT, series, and standard swap scheme quoted for the rate, the level. Inverted expectation is also loose. Inverted curve mixes expected policy curve with the term premium that can itself be negative, right? So the shape is not a clean forecast. Where it is used, curve rates are expressed with space, 2 by steadiness, keeping butterflies on the hum, outright duration kind of positions. Then we get to the next part, which is visual representation, term structure as a curve. Discount curve, alternatively, the term structure can be represented as a discount curve. is this key property DF0 equal to 1. Okay, since one unit received today has full present value and the positive interest rate, this is this. The discount curve gradually decreases with maturity interpretation. Longer maturity is implied with discounting reflects time value of money. Full equivalent to yield curve representation. Both curves include identical economic information in different mathematical forms, right? So again, DF of capital T plotted against capital T. Horizontal axis maturity, vertical axis discount factor. Formula 1 is DF of 0 equals 1. Formula 2, derivative of DF of capital T with respect to capital T less than 0. The discount curve slopes downward. The negative rate exception was covered on slide number 8. DF of 0 equals 1 is money paid today needs no discounting. That's the definition, the anchor point. Every curve construction must fit exactly. And what the bullet point tells you, the longer weight gets discounted, harder the discount curve and zero curve hold the same information in different form. Either one can be converted into other with no loss. Then we go to slide number 20, which is graphical comparison of term structure representation. Yield curve, discount curve, and 3D term structure surfaces. Yield curve is given, DFT is given, yield is given, right? So what's on the slide? 3 panels, no formula. Top left panel, horizontal axis maturity T 0 to 10 years. Vertical axis yield R T 0.02 to 0.06. Leverage units of 10 raised to 1 minus 2. Line rises from about 3% to about 5%. The picture shows a normal upward sloping curve. Top right panel, horizontal axis maturity T 0 to 10 years. Vertical axis TFT 0.6 to 1. The line falls from 1 to about 0.6. The picture shows the same information as the left panel discount form. The two panel agree the 5% 10-year rate and the corresponding is exponential minus 0.0. Exponential minus 0.5 is equal to 6.05. 0.6065, which matches the right panel at T 0 to 10. Bottom panel 3 axis maturity T runs 0 to 10, calendar time T runs 0 to 4. The vertical axis yield in units of 10 minus 2. Color tracks heights, blue for low and red for high. The picture shows the whole yield curve at each future date stacked side by side. Technical clarification here is the surface is one deterministic path of the curve through time, a real-term structure, model produces a distribution of such surfaces, one per simulation scenario. The panel shows the object being modeled, not the output of the model. It is used in Monte Carlo. Each simulated path is one surface of this shape. Pricing a Bermudan swaption requires the whole curve at each exercise date, not a single date, right? Then we get the next part, which is question number 1, discount factor calculation, which is given, pretty straightforward. R sub 3 equals 6% and capital T equals 3. DF of 3 equals what, right? So DF of 3 will be equal to, how do you solve it? It's pretty straightforward, right? You have to do what? 1.1.06 raised to power 3 to 0.8396, right? That's how it is done, right? So pretty straightforward. You don't have to think too much here, right? So pretty standard way of solving. Similarly, slide number 22. This is given again. R5 is asked. R5 is what? R5 is nothing but 1 by 0.7835 1 by 5, right? Sorry. You have to take combined. The question is asking zero rate here, right? Right. The question is asking zero rate, right? This is 1 by 5 minus 1 is equal to 5%. Right. So that is what has been that's how this has been given, right? So the 5-year discount factor is 0.7835. DF5 equals not 0.7835. R5 R sub 5 equals what? This is what the formula is, right? So straightforward. And then we go to slide number 3. Again, it is quite straightforward. We have to find P naught. P naught is a, see, solutions are given ahead also, right? So I'm just giving you a hint that this is principal plus coupon 0.92, 99.52. You can solve it like this. Not difficult at all. Next one, again given. DF1 is given, DF2 is given, right? Ask forward 1 to F1 to 0.95 divided by 0.90 minus 1, 5.56%. Solutions are given ahead, so don't worry about it. Slide number 25 of DF3 is given 0.85. R I have to calculate it. R equals 1 minus 3. Ln 0.85. equal to 5.42%, right? So that's how it is calculated, right? Because country's commodity rate has to be calculated. And then the solutions are given, right? Then the solutions of Y equations are given, right? So you can go and see the solutions. Not at all difficult, guys. Explanation given. I just explain you these to make it easy, right? Nothing else, right? Overall, the summary of this particular lesson is that the term structure assign one rate to each maturity. The discount factor is the rate and the present value multiplier. Rates in discount factor carry identical information, and either one can be recovered from the other under your annual or continuous compounding. You have to be aware of that. Every fixed income price is the sum of cash flow multiplied by the discount factor for their own dates, which makes the curvature a single point behind bonds, swaps, and forwards. No arbitrage forces discount curve to fall with maturity whenever forward rates are positive and forward rates themselves are just ratio of neighboring discount factors. Duration, DB01, HGM bond price, all rest of the same discounted cash flows. So the curve writes the risk numbers as well as the prices. And common mistakes on the material is you're mixing the compounding conventions, right? The 5% annual rate and the 5% continuous rate are different numbers, right? Converting your requires exponential RC minus 1, which is RA, uh, you know, discounting every cash flow at one rate. That is also each payment using the discount factor for its own date, using the maturity each for all date gives each maturity. Pricing, not curve pricing, assuming present value of float is equal to 1 minus DFT, still holds, then identity needs one curve to both forecast and discount. Under your OIS or SO for discounting, the floating leg must be built payment by payment, treating forward rate of forecast, right? That's also a mistake because forward contains a term premium at longer maturities. Convexity adjustment, these are hedgeable rate, not expected rate, and assuming discount factor cannot exceed 1, negative rate produce TF greater than 1. A rising discount curve, a curve code that hard code TF less than equal to 1, based on Euro, JPY, and Swiss franc history, right? So that's what we need to understand. Okay, that's it, guys. That's it for this. Uh, Go back, revise it, do it at least twice. Not very difficult, but yes, if you do it twice, you will be totally fine. And questions are given, solutions are given. I've quickly given you the hints. You go back and practice it, you will be able to do it, right? Look at the notes, you will have the adequate hints to solve the question. Okay. That's it, guys. That's it for this lecture. I'll see you in the next lecture. Okay. Thank you.